You may have heard something about lightning-fast traders picking off fractions of a cent from stock trades, but high-frequency trading, which uses computer technology and fast data connections to deal stocks at millisecond speeds, is on the move. In fact, the practice is pushing into new markets around the world and growing its presence in new asset classes such as bonds, currencies, and derivatives. The push comes as profitability in trading stocks in the US is on the decline. Justin Schack, managing director at Rosenblatt Securities, explains what's happened to the US market.
What's been happening since 2009, which is when we really saw the peak profitability for the high-frequency trading industry in US equities, is that the fundamental drivers of high-frequency profitability have been evaporating. And those drivers are volatility and overall volumes and demand for liquidity from end investors in the market.
According to Rosenblatt estimates, profits for high-frequency trading in stocks topped out at a median range of $4 billion in 2009 and spurred a growing number of entrants into the business.
A lot of people, rushed into this industry, and I think there were, like you saw in the dot-com era in the late 90s, or even with hedge funds in the 2000s, it was the new thing that everybody wanted to do. And you saw a lot of smaller shops, 1, 2, 3, 4, 5-person shops say, hey, I could take advantage of some technology in a box that someone is going to give me to execute high-frequency trading strategies.
But less turbulent markets and a decline in volume have sapped profits by 3/4, forcing those that survive the downturn to look for other products and geographies to trade in. Eric Knoll, a senior executive at NASDAQ OMX, explains what's taking place.
It's a global phenomena, and it's a global phenomena in equities as well as all the other asset classes. So they'll move around the clock, and they'll move into different venues and opportunities as they exist, or as they see them exist.
In fact, high-frequency trading market share in some asset classes, such as foreign exchange, has picked up to almost 40%, according to estimates by AT Group.
As they appear in these other asset classes, they will start to drive those markets towards a more equity-like structure. I'm not saying necessarily an exchange, but a more equity-like structure, where there are visible bid offers, where there is a tape for people to look at. And for ultimately investors, buy side, retail, and otherwise, to start thinking about what does it mean to get best execution in those other asset classes, where previously they were opaque markets and there was not a lot of visibility to them.
But the potential downsides are markets plagued by computer glitches, outages, and most worrying of all, the risk of a global flash crash across major markets linked by the speed traders. That concern has prompted top regulators in Washington to warn that the spread of high-frequency trading into other markets could lead to unintended errors cascading through the financial system. But others are not worried and are rushing to meet the demand, as most everyone agrees the spread of electronic markets is inevitable across the world and in other asset classes. After more than a decade in building electronic platforms for high-frequency traders in stocks, Dmitry Galanov has launched FastMatch FX, a currency trading platform that attracts the business of high-frequency traders.
What was interesting for me in FastMatch and foreign exchange space is that from the matching technology perspective, and as I mentioned before, foreign exchange ECNs are about 10 years behind. Another reason that got me very interested in FastMatch and creating this venue is the high-frequency players, that I saw an opportunity where the high-frequency players start moving into other asset classes outside of equities. And in effects, there was not really a good venue that accommodated them, because they need speed, they need ability to send many orders, many cancellations. A number of venues in foreign exchange space are not transparent, there is no tape.
In December, Gecko Securities, behind me, acquired Knight Capital in a $1.8 billion bid to boost its equities business. But as high-frequency traders continue to confront a period of low volatility and low volumes, we can be sure that they will be continuing pushing into new asset classes and new geographies. For the Financial Times in New York, I'm Arash Massoudi.